All right, so there's a new IPO on the block. A company is asking for your cash, and they've got this huge story about breaking into railways and defense. Sounds pretty exciting, doesn't it? Well, we went ahead and did the heavy lifting. We read all 368 pages of their IPO prospectus, so you don't have to. And what we found? Well, let's just say this is the unfiltered reality check you need to hear.
So it all boils down to this one big question, right? Is this Defrail Technologies IPO a real high-growth opportunity? Or is it just a high-risk gamble wrapped up in a really good story? That's what we're here to figure out. Let's get into it.
Okay, so let's peel back the first layer. At its core, Defrail Technologies is a company that makes rubber products. Simple enough. But now they want to go public to raise money for a massive shift. They're trying to jump into two of the hottest sectors right now, railways and defense. And yeah, on the surface, that sounds like a killer plan. But you know how it is. The real story, the important stuff, is always buried deep in the fine print.
You know, every IPO is selling a dream. It has to. So let's take a look at the exact dream Defrail is pitching to investors, the one they hope is good enough to get you to open your wallet.
And here it is straight from their own prospectus. They want to, and I quote, increase turnover by 2 times and get 25% of that from exports. They're not talking about a little bit of growth here. Now, they're swinging for the fences, aiming to double the company and become this preferred supplier. This is the big story, the narrative they're building to get everyone excited.
So how are they going to do it? Well, here's their plan for the IPO money. And on paper, it looks pretty good, right? They're going to buy new machinery for the big expansion. They're going to get into solar to cut costs. And this is a big one. They promise the promoters aren't cashing out. It's all for growth. The story is, well, it's holding together. For now.
Okay, but before we get too caught up in this exciting future vision, we need to plant our feet firmly in the present. What does this company actually do today, like right now?
And this is their reality. They're making industrial rubber parts. Things like flexible hoses for machines, and those connector things, vestibules between train coaches. Look, it's necessary stuff. It's functional. But let's be honest, it's a world away from the high-tech, cutting-edge defense contractor image they're trying to sell us, isn't it?
All right, here we go. This is the moment of truth. We've heard the story, the big ambition. Now let's see if the numbers actually back any of it up. This is where we separate the marketing hype from the cold, hard math.
And wow, right away we see the first huge crack in the story. Look at their net profit ratio. It's just 4.46%. Now you might think, is that good or bad? Well, let's compare it to one of their competitors, Pentagon Rubber. They're pulling in a profit margin of almost 15%. That means Defrail is less than a third as profitable as its peer. That is a massive, massive gap in performance.
Okay, if you thought that was bad, hold on. This next chart is even more alarming. This is their return on equity, or ROE. Basically, it shows how good a company is at making money using its shareholders' cash. And look at this. It has absolutely collapsed, from a very respectable 64% down to less than 8%. This isn't just a little slowdown, folks. This is a financial nosedive. It tells us that the company's fundamental ability to make a profit has just fallen off a cliff.
And believe it or not, it actually gets worse. The deeper we went into that prospectus, the more red flags we started finding. So let's go through them one by one.
Red flag number 1 has to do with their basic housekeeping. You know, compliance and corporate governance. And when a company is about to ask the public for their hard-earned money, this kind of thing is a really, really big deal.
And look, this isn't a one-time mistake. It's a clear pattern. Their own document admits they've been significantly late filing mandatory legal forms with the government. We're not talking a few days late, we're talking over 100 days late on crucial filings. That screams a lack of discipline. It's just sloppy corporate governance, plain and simple.
All right, next up, red flag number 2. The company is currently tangled up in some legal battles. And these aren't trivial. They come with real financial and reputational risks.
So what are we talking about here? Well, there's a lawsuit trying to recover over 52 lakhs from them. There's another case about bounce checks totaling 9 lakhs. And get this, their own company logo, the one they're using for this IPO, doesn't even have its trademark registration finalized yet. I mean, come on. These things are not just potential hits to the bank account. They're signs of a pretty disorganized operation.
But honestly, all of those issues we just talked about, they're small potatoes compared to this next one. This is what I would call the ultimate red flag. For any serious investor, this should be an absolute deal breaker.
Okay, get ready for this.
In this massive 368-page document, a document whose entire purpose is to give you financial clarity before you invest, the company has somehow forgotten to include a complete profit and loss statement and a complete cash flow statement. I mean, it's unbelievable. They're showing you their balance sheet, but they are hiding the two most important reports that tell you if they're actually making any money and where their cash is coming from. It's a deliberate omission of the full story.
So let me just ask you this, point blank. Would you ever invest your money in a business that flat out refuses to show you its financial scorecards? A business that won't tell you if it's profitable or bleeding cash? I think we all know the answer to that.
So here we are. We've weighed the big, ambitious story against the pretty grim financial reality and this growing pile of red flags. So what's the final verdict for you, the investor?
Let's make this really simple. If you are a safe investor, you avoid this. If you're a moderate risk investor, you avoid this. Frankly, if you're any kind of investor who cares about fundamentals and knowing what you're buying, you stay far away. The only person who should even think about touching this is an extremely aggressive trader who's treating it like a pure gamble, a lottery ticket, nothing more.
So, our final verdict, based on nothing more than the information inside the company's own prospectus, is crystal clear. It's an unambiguous avoid.
So let's just recap why. First, the missing financial statements, that's just unacceptable, period. Second, the numbers we can see show a business whose profitability has completely collapsed. Third, their corporate governance record is shaky at best. And finally, yeah, the growth story is exciting, but the foundation it's built on is incredibly weak. Look, in investing, a great story can never, ever make up for bad numbers. And in this case, you can't even see all the numbers. When a company is deliberately hiding the most basic information, the risk just isn't worth the gamble. It's as simple as that.